Hello, everybody. This is Chad Nash. Just waiting for a few more people to get logged in here. If you are on, can you just say hello so that I know people are able to access this room? Also, let me know if you guys can hear me as well. So I've been trying to do this mic check all morning, and inevitably, it's always something wrong with the mic at the last minute. So I just want to make sure people can hear me. So say hello if you're on. I see people entering, but nobody's saying anything. I see Steven say good morning. Good morning, Steven. I see Amber. What's up, Amber? Anybody else on with us? So I see a few participants on. Lambo, what's going on, man? I'm glad you could join. Thought you would have been out having a steak dinner or something right now. All right, so it sounds like everybody's able to access. If they're not in, they'll be trickling in. First and foremost, I want to say thank you guys for taking time out of your day to join me on this presentation. So it's called Hope in the Unseen, Faith in the Unknown. Now, I want to give you a couple of parameters just to forewarn you with everything here. So as many of you know or have been to my talks before, I love to speak. I love to educate, but this is the first time I'm actually doing it on a webinar platform. So it's a little weird, right? Just talking into a camera, and I usually feed off the energy of the crowd, right? And I can see people who are shaking their heads, or they're giving me a weird face, or they're laughing, or they're falling asleep, but I can't see any of that on here. So I'm just going to talk, but if there is anything as we're going through this, if you guys could give me an LOL in the chat so I know if my joke is funny or not. That was a test. You could put LOL because that was pretty funny. If you're falling asleep, just put Z's on there. If you're confused, put a confused face so that way I kind of can follow along with the crowd. And you guys are my first group here, so we're testing this out together, so I appreciate it. I'm going to try to answer as many questions as possible. So we only have 30 minutes, and I want to be very respectful of your time. So I won't be able to answer all questions in real time, but at the end, I'm going to save some time for question and answers. And if you just want to ping me, we can talk in the chat or via offline if that works for you. On the slides that I'm going to present here, there's going to be a lot of information, and I did that purposefully. Because I'm going to cover the highlights of each of the slides. I don't expect you to read through the slides. That's why you have me here. But you will get a copy of the slides afterwards. So you can read through it. You'll have the exact same presentation. And then that will kind of trigger you to say, oh, yeah, Chad did talk about this in the presentation. And the last thing here is, obviously, you guys know that I'm in real estate. And when I started marketing this presentation, even some of my old clients were saying, what are you trying to sell, man? You guys know I don't try to sell anything. So this is not an opportunity to sell. I'm not trying to get you to do a real estate transaction. If you do a real estate transaction, do it with me, but I'm not trying to do that at all. This is just about empowerment and education. So I hope you guys find it as such. What's up, Hillary? What's going on? Miss Chin, what's going on? I thought you would have been out golfing today. So what's up, Stacy? Donovan? We got Ishmael here. Yeah, we got some good people on the call here. So now remember, this is going to be you're going to have this same presentation again in replica form, a replay. So you'll get this. So if you miss any part or you got to step off, it will be sent to you. All right, so let's jump into this thing. All right, I want to start off with a quick faith analogy. Now, this whole presentation, if you know me, you know I'm a man of faith. You know I'm a man of inspiration. I'm a man of belief. And I think that a lot of us get to where we are in life by having faith. So the context of this presentation is based on faith, right? Faith in the unknown. Now, imagine you're standing before a foggy bridge. You cannot see the other side, but you step forward, trusting the builder. Faith is not waiting for clarity, but moving forward despite uncertainty. Real estate investing follows this same principle. You move first, the results will follow. Embracing courage, transform hesitation into progress. Now, you can look at real estate as simply transactional. I know a lot of folks who look at real estate and they say, oh, I just want to buy a house. That's transactional. We know we need shelter, right? But the way I look at real estate is from a perspective of ownership. So it's a transformative process of ownership. So it's not just a house, but it's creating a home and it's creating a legacy. And in order to do that, we have to step out on some things in faith to understand how it's going to work out for us, because it always does work out for us if we have tremendous faith. Now, before I get started here, why this conversation matters to me: social mobility. That's going to be the big driver of why I do real estate. So we'll talk about that a little bit more in depth, and why it turns in, how it ties into what we call generational wealth. I want you to unlock financial freedom, and I want you to do it understanding that we are in a complex time, we are in complex markets, but that actually breeds more opportunity for you to succeed and get ahead of others if that's what you're looking to do. I want you to have a clear purpose and a fresh perspective of what the market is going to do in 2026. And if you so happen to choose, we can connect and talk about a personal plan for you on how to achieve your real estate goals going into next year. All right, who am I? Who are you talking to on this platform? So obviously, many of you know my story, and I'm not going to go too far into it, but I do want to kind of jump from where I grew up to where I am now. So I am from Denver, Colorado, born and raised. I'm a Denver native. Grew up in an area called Montbello. So if you know anything about Montbello, you know that it was full of inequities, inequalities, a lot more risk, lower expectations. And initially, as I progressed through my life, I wanted to give back to my community and those who look like me through education, because I felt like that was social mobility. Now, as I jumped into ownership, and there's a whole story in between that I won't bore you with now, but maybe for another presentation, I have come to learn that real estate is truly a path to social mobility. It's truly a path to generational wealth. Is truly a path to legacy building. Yes, education builds into that, but anybody that we know that has a means or has wealth, it comes through ownership. I've seen plenty of rich people who don't have educational levels or educational attainment. I don't see many rich or wealthy people who don't have ownership, if that makes sense. So, am I just a beat off the street? Absolutely not. And I'm not going to spend too much time so we can get into the content of the presentation here. But here's my achievements and here's my recognition within the industry. Just plain and simple, I will say, you guys know who I am. Most of you do. You know I'm a beast at what I do. You know why I do this. And you know that we do this very successfully. So when you look at this presentation, understand that you're getting the perspective of a top performing realtor. And you're also getting the perspective from a realtor whose client base loves him. And I do want to circle this part here. The earned 150 plus verified 5-star reviews across Google, Zillow, Realtor.com. You know that this is no fluff. So this is all for free for you. All right. Okay, the sociology of ownership. Now, this is my why. This is why this presentation is so important to me. Homeowners hold a median net worth of about 40 times greater than renters, underscoring homeowners' vital role in wealth building. Ownership also promotes educational attainment. So going back to what I talked about in terms of, is it education versus ownership? Homeowners are also much more likely to be civically engaged. Now, we understand the political arena that we're in today's age. We know that it is very important to be civically engaged, and ownership promotes that. But the biggest thing is creating legacies, right? So it's not just about buying a home. For me, it's about creating generational wealth and legacies. Here is a big picture of why ownership works. And I know this is not my artistic ability. I know these houses look like something I would have drew, but this is just how it came out in the chart. But I just wanted to give you a real quick example of the gap right? The wealth gap when you own a property. So if we look at a 10-year trajectory of owners from 2015, if you bought a house in 2015, we're just going to say on average, if that house was valued at $310,000, today it will be estimated at roughly $610,000. When you talk about investment, right? I know a lot of people think of this idea of equity and property appreciation. They think of this on a very surface level. That is $300,000 that you've gained in your pocket simply by owning an asset. So that's ownership in a nutshell, okay? But there's still a lot of folks who sit on the sideline and they don't know if they want to jump into this investment class called ownership. Now, I'm going to talk about some of the objections that I hear from buyers, and then we're going to look at what the market is telling us. One of the biggest objections, and I know we have some lenders on here and they can verify, give me an amen, give me a praise in hands if you've heard this objection. Rates are too high. I'll just wait until they drop. Okay? Has anybody heard that objection? Nobody has heard that objection. Well, I see a couple of people putting their praying hands there. Absolutely. So that's one of the biggest objections that we hear. Buyers delay due to the fear that rates have to fall before they purchase. Now, I'm not going to give you that old school analogy that we always hear. Our parents were buying when it was 10, 15, 20%, because house prices were a lot lower back then. We understand that. But this is the number one objection that I hear. The primary concern is affordability. A lot of people aren't afraid of missing on opportunity. They just feel like it's too expensive. We're going to talk about that here in a second. But the market activity doesn't pause. Prices, no matter what, are going to tend to rise over time, regardless of what the market is doing. And we'll see that in some of the data that we look at here. Waiting can compound the total cost despite future lower rates. We're going to talk about some examples where waiting actually costs folks more, even when rates come down, if they waited 2 or 3 years. And understanding this is going to help you be proactive to understanding why is buying important in any market, right? How do you get through it and why it's a long-term investment? So here's a quick story of a client of mine. I'm just going to use the name Jasmine, right? I just made this up. So, and I didn't make up her story. I just made up the name on it. So this is a real story. Jasmine waited to buy at 7.2% interest rates in 2023. But she came and told me, well, I just want to wait because that interest rate is just a little bit too high. So by 2025, the rates fell to 6.4%. But guess what rose on top of that? Especially here in the Denver market, because prices always rise. The home prices rose about 8% from 510K to 550K. This means that in total, her monthly mortgage payment actually would have increased over that time by roughly about $230. So she was looking to save money because interest rates did go down by about, maybe about 0.8, but home prices rose about 8%. She actually lost out on about $70,000 in cost in equity that she could have earned, if that makes sense. Okay, so her thought of waiting until interest rates go down, and we're going to look at this economic paradox in a second. Home prices went up, meaning that the mortgage was going to be more, taxes went up, all HOAs go up, all of that stuff. She lost out about $70,000 when she thought she was going to save waiting a couple of years. Why buying still wins in 2026? So let's look at this data here. In 2023, let's just take a home price of $585,000. That same home price here in 2025 would have been about $610,000. Next year, that home price is looking to be valued at about $640,000. Here's a big thing, because we know that we're in a softening market, and we won't get too much into seller concessions and defining all that, but just understand that we can talk this through. It is what we call a buyer's market, or at least psychologically, it's a buyer's market. That means that buyers have a lot more leverage, and sellers are actually lowering home prices to sell and providing concessions. So in 2023, when it was a little bit more competitive, on average, the concession was about $6,200. In 2025, this year, that rose to about $9,400. And going into next year, we're going to be somewhere in the middle, because we are going to start to see a rebound, and we'll talk about those dynamics. The average concession is projected to be about $8,700. Okay. The 30 years fixed rate, again, 7.2. We look at Jasmine's rate then. 2025 is 6.4, but we're already seeing that there's speculation that interest rates are going to continue to fall, even though we see these blimps down to about 6%, maybe between 6% and 6.3%. But here's the big thing. For those who have owned a property for 5 years in 2026, even with this turbulence of up and down, those 5-year owners are going to have equity of about $235,000. Okay, so that means that if they bought in 2021, they're going to see equity gains of about $235,000, even in a time when it feels like the market is going down. So here's the opportunities for buyers. We got increased inventory, right? We're in a market where there's a lot more inventory coming onto the market. And that means that there's a lot of buyer leverage. We saw that in the data where we got seller concessions, price drops, right? Even though they're going up, they're not going up substantially. But buyers have a ton of opportunity if they just take advantage of this unique window within the market. Same for number 2 here, entry point timing before the upside moves in. Guess what? When I talk about interest rates going down to about 6% and inventory going up, what is that going to do to the folks who've been sitting on the sideline? They're going to get off the sideline, right? Because they're like, oh my God, in 2020, 2021, I didn't have any houses to choose from, maybe just a house on East Colfax that had to be remodeled for $1 million. Now there's a ton of inventory, and I see interest rates going down. So guess what's going to happen? A lot of buyers are going to jump off the fence. And what is that going to do? That is actually going to push home prices back up, because it's a pure supply and demand issue, right? If you're looking for opportunity to purchase in 2026, make sure you're differentiating between product types and making a smart risk management decision. What does this mean? And I put a little bit more on this slide so you can understand that. But this is just saying, basically, we have 3 asset classes within real estate. Actually, we have more than that, but 3 main within residential. So we got condos, we got townhomes, and then we got single family homes. Okay. If you're looking to purchase in 2026, the smartest class to make an investment in right now is going to be single family homes. Okay. I know some people on here might argue with me and say, well, condos are a lower price point, townhomes are a lower price point. And that's true, right? And we used to say that that's a good starter way into home ownership. But guess what is taxing on those condos and townhomes? HOAs. So we're seeing an exorbitant increase in HOAs. So even though you're getting lower payments, right, PITI, when it comes to your mortgage payment, when these folks are now taxing on $400, $500 onto your HOA, that's actually really increasing your price point and your affordability. So the smartest investment still is to find single family homes in strong appreciating neighborhoods. It doesn't matter if it's not the nicest house on the block, because you can build in equity over time. But now you're actually paying the true amount of your payment. You're not paying somebody's HOA fee, if that makes sense. And then negotiation on terms in 2026, on terms and incentives, not just on the price. Okay, so before, when I get buyers that come to me, they just want to negotiate on the price. But there's so much negotiation that can take place on these properties right now, it's not even funny. So you can really get in and structure deals how you want it or how your lender needs it to favor you as a buyer. So this can mean rate buy downs, interest rate buy downs, right? So if affordability is a big thing to you, let's get in there and not worry so much about price, because price, here's a little tidbit for you. A $10,000 drop in sales price is not the same as a $10,000 seller concession. And if I could get one of my lenders to give me a praying hand on that, tell me which one would you prefer as a lender to see your clients get. Would you rather see a seller concession, a $10,000, or a price drop? In my estimation, a $10,000 price drop is not going to go as far as a concession. So we want to make sure we're negotiating on concessions, closing costs. And there's a lot of other things that I'm seeing buyers went out on right now, such as home warranties, such as homeowners insurance being paid. If you do move into a high HOA, have the seller pay for your HOA for 2 years. Okay, you can get that up front. So yeah, just make sure that we're looking at negotiating on incentives and not just the price. All right, let's look at the sellers here. Okay, so many sellers regret missing 2022's market highs and are waiting for prices to rebound. Holding out sacrifices crucial leverage and trade-up opportunities on the buy side. So now specifically, this is going to be a convoluted conversation because I'm really looking at sellers who are also staying in ownership. I'm not looking at sellers who are looking at exit ownership. I'm looking at sellers who are saying, hey, we want to sell our house and we want to continue to move up. Well, now there's two sides to the coin, and they're looking at both sides and they're trying to win on both sides. You're never going to win on both sides of a real estate transaction, if that makes sense. So you have to balance this nostalgia with equity gains, right? And you have to balance to say, okay, I see what's going on the left side of the market on the sales side, but I also see the advantage of what I can gain on the right side. I know I have a lender on here. We're actually working with one of my clients now who just experienced this yesterday, and I'll give that example in a second. But here's a good case study of that. I have a group of clients who they purchased their home in 2018 at $420K. That valuation peaked to $640K in 2022. Now the market has receded a bit and their home is valued at $605,000. So they waited for the price to rebound, but they missed buying their dream Parker home, which is now actually $65,000 cheaper with extra concessions. Okay, does that make sense? So they waited to sell their home, and now the home that they really wanted in Parker or a similar type of home is actually $65,000 cheaper. So selling today would have yielded them $180,000 in equity and would have saved them $65K on the new home purchase. So if we look at that, we say, okay, they're at 420. They could have sold today at 605. They wanted to sell at what, 640. Okay, I get that. That's a few more thousand in the piggy bank. I get that. But that waiting actually cost them about $60,000 in leverage for a mere $20,000 market gain. So they've missed out on an opportunity to tap into that accelerated equity, and they've missed out on an opportunity to buy in a very soft market. They would have been rewarded for their equity handsomely, but they wanted to wait because they felt like, oh, we're not getting what the house is worth. Well, the house now is worth 605 because that's what the market is paying. So if that makes sense to you, just give me a praying hands or give me an amen, or if it doesn't, give me a confused face. Here's some of the data to what to look at if you're a seller. Average days on market in 2020. Okay, this is in COVID. in Denver was about 18. In 2022, it was about 12. Now in 2025, we went up to 28. And I can tell you right now, all of my sellers panic when they go on the market because they're like, oh my God, we're sitting for a month and we thought we would have been gone off on a weekend. It's just not that kind of market, but homes are still selling. In 2026, it's forecasted to be about 21 days on the market. Okay, so again, the market is going to shift a little bit more downwards as we get more buyers, and that inventory starts to decrease a little bit. Even though it's increasing, more buyers is going to soup it up and it's going to decrease. So it's going to cause some of those dynamics with shorter days on the market. Average equity gains. Here's what's important. For 3-year owners in 2022, if they had owned for 3 years, they had 155,000 in equity gains. That means that they purchased before COVID, right? For 2025, these are the folks who purchased right after COVID. They had about 185,000. If you purchase in 2026, right, and you're talking about, okay, maybe getting a little bit better deals because the market was coming down, well, guess what? As this market starts to go back up, you're going to have about 195,000 in equity for 3-year owners, if that makes sense. Again, we talked about that average seller concession. Before, you were only paying a concession of $4,100. 2025, as a seller, you were paying $9,400. 2026, as we already looked at, is going to be about $8,700. But take a look at the buyer demand and just look at how this is flowing here. So in 2020, it was 6.8. 2022, it was 7.4. That means that's when buyer demand was at its highest across the data points we're looking at. 2025, it pulled back, and we felt that. Less buyers were out. Guess what? This number is going to start trickling back up again as interest rates go down and as more inventory comes back onto the market. So you're going to have more buyers out there looking, which could manipulate the data in your favor to, again, make the competitive, to make the Denver market more competitive. Here's the opportunities. Sell when the supply surge gives you leverage. And I'm not going to go through these in depth because I want to make sure I touch the investors part. Premium positioning for resilient home types. If you are thinking about selling, you need to make sure we're not out to clear yet, right? So we're not in the days where you could just throw a house onto the market and just take pictures with your iPhone. But if you're doing the right marketing and making the right investment up front, taking great photos, videos, making sure you're working with a realtor that understands your specific market, make sure you're doing the absolute most to get the most out of your realtor to prepare your home for the market. And I promise you, you will see great results. Act within the time-sensitive market window. What does that mean? There's a typical selling season. There's a typical ebb and flow to the selling season. Typically, we see Q1, a lot, buyers are beginning to raise their hands, coming out. They want to buy. Q2 is usually our strongest time. I typically tell sellers, if you're thinking about selling, right, the best time, especially right now, may be Q1 and going into Q2. It's always good to beat the rush, because if we do think that more inventory is going to come onto the market in Q2, well, guess what? It's not just going to be you selling on the block. It's going to be you and 4 of your neighbors. And that's what you don't want to see. Right now, I see so many competing yard signs out there. And then we just talked about this, differentiate with strategic value adds and storytelling. Okay, last one here. And this is one that I really want to get into, because I always try to challenge my owners to think about themselves as investors now. And if you're getting into ownership, you got to think about it as an investment. Debunking the myth. Denver is not just about cash flow. So I'm talking right now specifically to investors out there. When we have this kind of market where it's an ebb and flow and the market kind of tightens up, a lot of true investors, I should say rookie investors, confuse cash flow with overall return on investment. Now, yes, if you're looking at becoming an investor in this market, and let's say home prices are still high, you're not getting the rents that you want to get a great cash flow, you're going to think becoming an investor sucks. Well, guess what? Take it from me, because I am an investor myself. Denver's market builds its wealth primarily through equity appreciation and tax leverage, not just rent premiums. Let me repeat that again. Denver's market builds wealth primarily through year-over-year equity appreciation and tax leverage, not just rent premiums. Now, I'm not going to call him out on this. I know she's on here. So one of my investors that purchased years ago, I told them, I said, look, let's look at this neighborhood, and don't just think about how much you're going to make in rent. It might have been about $100 a month, but let's look at how much equity you're going to gain year over year. That's your honeypot. So you need to be thinking about, hey, forget if I only make $100. And I can tell you on a couple of my rentals, I've actually paid, $100 or $200 in the negative each month, but I've came out on top year over year based on the equity, if that makes sense. Waiting for the market to dip to invest, risk missing critical growth opportunities. You got to understand the full ROI picture as we're looking to purchase in Denver. So don't just look at my rent is tight. I'm not going to be able to make this happen. Let me give you a quick example of this. I know we're running short on time, and I'm going to wrap up soon. So Alex, I had a client. I'm just going to call him Alex. He passed on a $590K Airbnb duplex, which later sold for $580K. That property this year now has appraised for $660K, right? Because he didn't think he was going to cash flow a whole lot. That duplex generates about $3,200 in net income monthly, totaling $38,400 annually. With that $80,000 that he saved, because he didn't want to jump into the Airbnb space and do the duplex, he invested it into like a money market account, and I think he made about $6,400 in that same period. Had he invested, that equity today would have been about $180K with $30K net annual income. So he would have had that, would have appraised that, right? Plus this annual income, he would have been up $120,000. I don't care if you only made, $50 on your monthly rent to cover the mortgage. If you would have made $120,000 over that period of time, that investment was well worth it. Let me know if that makes sense to you guys. Here's some metrics on the real estate investing side. So the average rent growth went from 3.8 to 4.2 to 4.5. It's continuing to grow. There's going to be more renters out there because people don't want to buy. Okay. The median home value is going to continue to go up. So that means your equity is going to go up. 495 to 525 to 550 projected in 2026. Here's an important metrics, and I'll talk about this in a later investor webinar. We'll talk about the cap rate and why that's important. But the average cap rate across Denver from 2023 to 2026 is 5.2 to 5.8. That's in an investor's favor. Airbnb, one of my favorite things, because I love Airbnbs. Airbnbs, I know a lot of people are people still Airbnb. I can tell you my places stay full. The average occupancy across Denver is 60, in 2023 was 68%. 2026 is going to continue to climb. And then we'll talk a little bit about DSCR loans. I know I got some lenders on here. These are the interest rates for DSCR loans. That's what a lot of investors use. That's actually dropping to make it more affordable for you to get these loans and do rehab on certain properties that you want to do. So from 7.8 to 6.9. Here's to sum it up, folks. Real estate is still working, right? I don't care what market it is. I don't care if you're a buyer, seller, investor, whatever it may be. 11 to 13% annual returns. The volatility is still low. I know we're looking at it and like, man, this market is upside down. It's going to collapse. No. These other asset classes have much more volatility if you're thinking about investing in it. And I'm not saying not to invest in it. I'm just saying that we are actually in the most, the least risk averse asset class that there is out there. Look at that compared to the stocks of the S&P 500. So that yields about 8 to 9%. Bonds only 3%. That's why I made it so small. I remember my mom used to give me bonds when I was young, and I used to be so happy. I wish she would have got me real estate. Cryptocurrency, now that is a 20% return, but the volatility on cryptocurrency is astronomical. I'd hear people one day, they're like, man, I'm a millionaire off of crypto, and the next day they're calling me, asking me for a loan. So I don't know what's going on. I've never done crypto, but real estate is pretty dependable. All right. So the strategic investor opportunities, I'm not going to go through all these in the interest of time, but just take a look at this slide here, and you can see buy during supply surge in the upcoming correction. Okay, there's opportunity there, and I'm happy to talk with you more about that. Rental demand stabilization and the future upside. Renting is still happening in Denver. Don't get scared off because there's a lot of rental opportunity out there. But what I will say is, oh, my guy Lambo said they don't have the right strategy in crypto. Yeah, that's because you're making all the money, bro. Product type differentiation, pick the right class. Don't just go out there and invest. Again, this is just like I was telling you with the buyers on the buy side. I'm not big on making rental properties right now from condos and townhomes unless they're in areas that have astronomical equity, because again, what is going to eat into your margins are going to be the HOAs, right? So that's a big thing. We need to make sure we talk about that. All right, so you're at a fork in the road, and here's where we're going to end, okay? We always come to this point in life where we say, hey, if I'm thinking about doing something, I can either sit on the fence and kind of watch what happens, right? Or I can get off and make things happen. You can look at this option A and try to wait for the perfect conditions. Here's the thing. There's never going to be perfect times in real estate. It's just not. It's always going to be one or the other. One side is going to win, one side is not. But it's always an up and down for everybody that's in real estate. Option B is, okay, how do I start to plot out my plan to make sure that I can be strategic if I do decide to get into real estate? Ask yourself these 3 questions, and I'll tell you what the next move is for you. If you believe that real estate creates real wealth, and that's a yes. If you believe that you deserve to build this wealth through one of the strongest asset classes, if that's a yes. And you can ask yourself, are you ready to take the first step to that? I sound like a preacher. I sound like a preacher that's asking people to join a congregation. That's not what I'm doing. But if you ask these 3 questions to yourself, then you may be in a position to take the next step. And that's where you can reach out to me. You can work with me. I would love to sit down with you and help you game plan a 2026 real estate roadmap, taking into account all of the opportunities, taking into account all of your aspirations, goals, and things of that sort. So what I'm doing next year is I am releasing my framework. It's called the Vision Framework. This is VISION. Visualize your why. That's the V. Let's identify your role as a buyer, seller, or an investor. Let's strategize your team. I got some great lenders on here that I work with continuously. Let's get the right folks in place. Let's get wealth managers. Let's get accountants. Let's surround you with the right people to help you make some good, help you make good decisions. Because I don't have all the answers. They do. Let's initiate action. Let's put together that game plan. And then when you accumulate that game, when you get that game plan and you do make your first purchase, or you do decide to sell, or you get that first Airbnb, let's talk about how do you own and protect that asset. That's big to me. And then let's nurture and reassess that annually. So this is my framework on how I will guide you to help you gain real estate wealth or wealth through real estate accumulation. So I hope that is helpful, guys. I wanted to give a real quick summary on the market there. Let me know if you guys have any questions here. The big thing I want you to take away is that I am here to, here's the offer that I'm going to put up there. See if I know how to work this. You can set up a time to meet with me about your vision framework if you want to, if you're thinking about buying, selling, investing, or if you just want to ask questions. That's what I am here for, is to help educate you on all the opportunities out there for real estate. So I want to go ahead and open it up for some questions. That's the end of the presentation for those who need to jump off, but I'm happy to answer any questions that you guys might have. Any questions? I see Steve, is that index saying that there are 6.5 buyers for every one home in 2026? That's actually a good question, Steve. So I pulled that index from the DMARS site, that, and I know it's an index of a lot of different statistics that they put together that talk about home buying behaviors. But I can find that out and send that over to you as soon as possible. All right, guys. Well, that's it. If you have any questions, feel free to reach out to me. You have that offer here. You can set up a time to chat. You can also email me, text me. I would love to work with you in 2026. Also, be on the lookout. I'm going to have more webinars. This is going to be my big thing for 2026. So I'm going to have a lot of different topics that I'm going to talk on, just quick hits. I would love for you guys to tune in and join if you find it to be a benefit. I appreciate you guys.